quick little run through of how a discounted cash flow works. So right here you can see a little spreadsheet that I made. If it looks weird, don't worry about it. Just to kind of give you a brief overview of the actual spreadsheet, right here is a section for where we're going to put down all our data that we currently have for the last 3 years of a company, and then we're going to forecast forward around 5 years. Right here in other items are some pertinent line items that we would need to make one of the operating income measures transform into free cash flow. And then down here is the actual discounting section where we get all of our operating income, convert it into free cash flow, discount it, and then get the firm's value, subtract out debt, get the equity value, divided by the total shares outstanding, get the actual share price of a company. So once you sort of know how to do a DCF, you can practically value any company you'd like or any company that you're interested in valuing. So just to give you a little kind of context, I put some of these numbers here as inputs. These are arbitrary. You could switch these up for any other number that you'd like depending on the company you want to do. But here, let's say it's in just singles of dollars. So 2,000 in revenue going up a little bit. For cost of goods sold, that's essentially the expense that each it's typically variable. So each product that you sell has a cost associated with it. So that's sort of the cost of goods sold or cost of sales. That gets you gross profit. Your depreciation amortization is essentially the sort of fake costs that come with the equipment and such that you would have in a company. Then you have your selling, general, and administrative. Any cost that's associated with front office, selling your service or product. So things like marketing, office space, etc., computers even would go under SG&A. And these percentage of revenues, let's fill that out right now. This comes in important for forecasting. So we would just do the actual cost of goods sold over the sales, which is revenue. And then we just do this, Command R. Let's make this a percentage. So we could see that roughly cost of goods sold as a percentage of revenue would be 50%, which means the gross margin, which is the complement to that, would also be 50%. But we don't have to worry about that so far. For DNA, same thing. We would do this, the actual expense amount over the revenue. And the reason we're doing revenue is because for most basic forecasting, percentage of revenue or percentage of sales method is kind of the commonly used method of forecasting. And it pretty much works well to a great extent because of the fact that typically when a company grows, it grows with its sales first, and everything else is sort of a product of its sales. It's associated with the sales rate. So if the sales is growing by X percentage, then it's typical to see that the other things would also grow at a similar percentage, or it would be a percentage composition of that sales. Anyways, continuing with SG&A, same thing, this over the 2,000 up at sales. Similar thing with percentages for ease of use, boom, boom, also 5% for the sake of simplicity. That gives us operating income down here. And this is income that basically demonstrates the profitability of the company before any interest or taxes are taken into account. So now, let's take some averages. And the reason we're taking averages is because this can be a good little point of reference for when we do let's italicize these. This would be a good point of reference when we actually forecast, so we can choose to do either the last figure in 2022 or we can choose to do an average if things vary. This is just where the art part of finance comes in. So for the most part, let's do something like this. Let's say something happens to the firm, I don't know, economic downturn. We don't think that it's going to continue growing at the rate that it's growing at. And we do, I don't know, equals, lock it at exactly that with this and make it stay the same. Well, that would be kind of bad for the purpose of doing this DCF. So let's do something else. Let's do the growth rate. So let's see, 2021 over 2020 minus 1 gives you the growth rate over the years. So from 2020 to 2021, the revenue grew by 10%. From 2021 to 2022, the revenue grew by 9%. So let's say we, instead of this average, we use this 9% value for the growth. So all we would do is we'd go here, take the 2022 value, and then multiply that by 1 plus this, lock it. Oops. Lock that. And then see where that takes us. So by the end of 2027, we estimate that this firm or whatever this company is going to have roughly 3,115 in revenue. Let's fix this up a little bit, make this look a little bit nicer. As far as cost of goods sold, what would be interesting is we could do this. We could take this constant of 50%, lock it to this number, and then from there work backwards to derive this amount, this cost of goods sold amount. So this would simply be this times this 50%, giving us the actual cost of goods sold amount. Let's clean this up. Our gross margin is simply the complement, which would be, wow, this Excel sheet is very smart. So yes, it would be the revenue minus the cost of goods sold gives you the margin, the gross margin, in dollar terms. And then same thing with this, we would do equals this, lock, forecast it out, this, lock, forecast it out, and then we'd figure these out in reverse direction. So this is equal to revenue times this percentage composition. Clean it up, boom, equals revenue times percentage composition. Clean it up, and because both of them were 5%, oops, wrong number. Because both of them were 5%, it would turn out to be the exact same number for all of them. And then let's just recompute these values. So now it looks like EBIT for the forecast years would be starting from 1,047 all the way to 1,246. So now is the part where we go down here for the discounted cash flow, where we actually start valuing this company. So we forecasted this operating profit. This automatically attaches to here. Very simple. Goes up to 2027. We'll talk about terminal value later. We're going to take basically EBIT, subtract away the effect of taxes outside of the effect of interest, because we're doing an unlevered free cash flow approach. So we're not taking into account interest for the sake of valuing the entire firm. So we're going to do this, the EBIT times, like the formula on the left side, 1 minus T, which is the tax rate up here. So we already have these estimates down here, so we're just simply going to link, boom, 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 clean it up, Command R, DNA. We actually have those estimates as well. We're going to go here, find the DNA. Where is it? It's over here. We're going to link. Going to forecast, change in net working capital. These are some of the other terms here. We have some assumptions. And then CapEx, same here. So as you can see right here, these are sort of the signs that we need to use to come up with free cash flow. So we're going to do no PAT, then we're going to do add back depreciation minus change in net working capital minus capital expenditures, because these are cash flows that are coming out. Do that for all years. And then for terminal value, it's this weird interesting formula where you go equals the last forecast year's cash flows times the kind of growth rate that you expect this to continue growing at forever and ever and ever. So typically this is like 2 to 3%, similar to what GDP would grow in the US. So let's do 0.0, or technically 1 plus 0.03, so let's say 3% growth. And then let's do that over, I'm putting extra commas because we're going to do a big function of a fraction, and then it's going to be the point at which this chart, if you like lay it out in a graph, they would have to intersect somehow. So it would be the WACC, which is equal to this number, which stays constant, so we'll just do this, minus the growth rate again, which is the 0.03. Let's make this also in parentheses. That gives you our terminal value, which is basically the value, the horizon value of this firm, given the fact that the firm is going to consistently continue growing at the same rate as the economy. And then the intersection of that 3% and the WACC is what causes the value to not keep going up and up forever. So let's go clean this up. 15,677. And then let's clean this up a little bit. Let's make this G, or growth rate. T, growth rate. Let's make this a little bit simpler to understand. And then this wouldn't really be a year by year kind of a thing technically, because and then we'll make this 3%. And then that way we could just simply link this here. And all I'm doing is I'm just simply making this a little bit more like functional and scalable as a spreadsheet. Still yield the same thing. Okay, cool. The present value of this would simply be the free cash flow over 1 plus the discount rate, which is the WACC, or the cost of capital, to the power of the discount period. Boom. Do that across. Notice how the terminal value would get discounted by, okay, something's not working. Oh, oops. I think I did not lock. Let us lock that. Okay, should be good. Let me double check this. Boom, boom, boom. Yep. Let's clean this up. And notice how this discount period is the same as this. It's just the way that the terminal value works. You would discount it at the same discount period as the very last year of the forecast you do. And then so that allows you to get enterprise value, which is the value of the firm to both debt and equity holders, which means that's technically not your stock value or your share price or your equity value. So you would need to take away the effect of debt. You would do enterprise value minus debt. Let's say debt is, this is an input, put this in blue. This is an input, put this in blue. Oh, shoot. Not that kind of blue, this kind of blue. So let's say debt is 500. You would arrive at an enterprise value of 13,195. Take away 500 from debt, you would get an equity value of 12,695. Shares outstanding is just the amount of total shares of stock there are, and so to get the price of one share of stock, or what's trading in, which technically should trade at the market, it would be this value. So let's clean this up a little bit. Let's make this $1, and then boom, share price. So this is, let's make this like nice and bold. This is the intrinsic value of the firm, given the fact that, let's say, these assumptions up here are as accurate as possible. We're basically saying that the cash flow generating capability of this firm demonstrates that this firm should be valued at $12.69. But the reality is, because of market conditions, because of uncertainty, because of whatever others or the common investor sentiment is, it might be that the market views the share price currently as, I don't know, $14.10. Which means that difference, percentage difference, means that it would be this over this minus 1. Share price, current price. So that means it is technically overvalued by like 9%. C35, C36. Yep. Which means if the market were to sense that these projections are as accurate as possible, and they also believe this exact same sentiment, then currently this stock, which with the current price of $14.10, would be overvalued by roughly 10%. So that's kind of a basic understanding of how to do a DCF. Just to walk through the process one more time, we took historical numbers, 3 years worth. We forecasted out some of these inputs, which you can find off of financial statements. Obviously, these are very simplified. You could do a very similar method to other more individual line items, but this is just a very basic exercise. Once we forecasted, we sort of got these percentages to help us forecast forward. Or sorry, not once we forecasted. Once we put in the historicals, we got the percentages to forecast forward. So we used this same 50% to forecast these expenses, which allowed us to get to this bottom line, this semi-bottom line of EBIT, which then allowed us to translate this operating measure of cash flow, quote unquote. The reason we wanted to get to free cash flow is because EBIT contains things that are not included. For example, DNA is non-cash, so we have to take that out of account. We have to add the effects of capital expenditures because that requires us to spend cash. We have to take into account of the change in net working capital, which is current assets minus current liabilities. That typically goes up a little bit over time if your sales grow. So we have to take that into account, which means our cash slightly decreases more. After that, we do this little formula. You can find this in CFI, Investopedia, Wall Street Prep. All of them have a similar formula. You get to the free cash flow to the firm, or unlevered free cash flow. This is the value of all the cash flows to basically all stakeholders of the firm, which includes equity holders, debt holders. But that isn't enough. Once we find the present value, we sort of need to work backwards to get only the share price, what's available to the equity holders, or what we see in the markets. So to do that, we subtract out debt, we get equity values, divide that by shares outstanding, we get the intrinsic share price that this company is supposed to technically be at, and then compare that to the current price. We can see a disparity. If there's a big enough disparity, like roughly 10%, 10% is a pretty good disparity given current market conditions in the recession. Typically you want to have something above 8% to warrant an investment. Otherwise you would just have to, otherwise people would just choose the S&P. But if I talk too fast, I'm sorry, but this is kind of the basic way to value a company through a DCF. If you have any questions, shoot them in the comments below. More than happy to answer questions and maybe update this model if you have any other inquiries. So, where did my camera go? Anyways, thanks for watching.